What is going on, guys? What is going on? I just want to show you something today. The easiest way to understand smart money concept, okay? You can call it ICT smart money concept or smart money concept, but this is the best way to understand the smart money concept. Let's get to it. Now, what you want to do is to slide that chart to the right side so that you can get a clean page, right? Cool. Then I want you to draw a push to the upside, push down, just your normal structure, just your normal market structure, up, down, the high, the low, the high, the low, the high, the low. Okay, so let's do that one together. So we're going to start on the upside, high, low. This is a normal market structure, high, low, high, low. Now go on a downtrend, low, high, low again, and that's it. This is what I want you to draw your chart like that. Okay, so I'm going to delete this because we don't need that. Now on the top, first high in the top, that should be your what, your liquidity, because of the order. Okay, and then when we push to the downside, that should be your liquidity again. Push to the upside, liquidity. So every high, we can just name that liquidity for every high. Okay, now when we're starting here to this whole push to the upside, if you see that market structure, it cancels itself. What do you mean? So if we have a push to the upside, we need a push down. In order for us to take this push, we need that aggressive push. In order for us to clear this high, we need to come back down and start over, right? So when we start over, we need to come to that level right there. Okay, that is the level we have to start over from, that level. Okay, so the same thing, it pushed up, it pushed down. In order for us to cancel that high, we need to come back up. Okay, so we left what? Another open candle there. Okay, and then we have another push, we have canceled that, pushed up, push low, we have another push to the upside, we left a candle there. Okay, so that is the first structure of the uptrend. Okay, but now when we're pushing all the way high, we are leaving all these beautiful candles right here. We have another push right there, right there. So what we'd like to see is when the market comes back to those areas, the market should react to those areas, which is the area of the order block. Now, okay, so we're going to have things like this. Okay, so this is just for the upside. So this is like your buying model. So what you want to see, you want to see the first push. Market has to cancel the order. It has to take out the order. Yes, it did. It pushed to the upside, right? When it pushed to the upside, it left all these orders that are open here for you to follow their steps, meaning that when they push back to the downside, they have to close that order and then continue back up to cancel that order. Now, that is when you can wait over here. Okay, for that. Okay, so simple, like that, like that. You can do this over and over again. Like that. Okay, so we had a push, we got cancelled, we wait over here, market came, we bought on the what? On the higher low. So reason why we have to wait for the higher low, because of market is on a discount, it is cheaper. You cannot buy high. So that is why you have to wait for them to come to the liquidity, let them take it out. If you were to buy right here on the liquidity, what's going to happen? You're going to come up with the market, be in profit, fantastic. But the market's going to come back down because it has to close the order and then come back here. That means you are on a drawdown, which is a drawdown, meaning that you are now in red. Okay, if you have a small account, prepare to blow. If you don't have risk management, prepare yourself to blow. So you have to wait for that thing to come back to you. Let it come to you, because it will come to you. It always does. It's going to come back to the downside. Okay, now we're not done. That is the uptrend. That is still open, liquidity. So every higher high, that's liquidity. You push to the upside, it's going to cancel the liquidity. That means this is where most people have come with the term, the demand zone, right? So right here, when it canceled that high, if you notice on an uptrend, once they push aggressively, when they're about to finish the trend, they always leave that long arm. If you go to your chart, you will see this. That long arm is the arm they would use for that retest. Okay, so you can just take your box, use the last liquidity right there. You have to practice, guys. If you don't practice, you're never going to see this. If you just draw the chart as I did and follow what I'm saying, you will see it. It happens all the time. And then you put the box right there, let it go. It's going to come back here, because here, that long leg, there is an order they have to close. They will close the order, right? When they close the order, they're going to come back most of the time on this leg, right? Now we're closing, we left liquidity because that's a higher high. But now on the last higher high, because now they will accumulate what? Orders here, right? So when they accumulate orders, you wait. You wait. You never rush. It's smart money. You don't rush, you wait. Okay? You let them come down. They will come back down to the leg. When they get back to the leg, wait. Because if you're going to sell, when you're coming back to the selling model, or when you come back to the downtrend, you're going to sell very low. You can't sell here. We have to sell high to make profit, right? So we sold. We're going to wait right over there, right? And there we're going to get our entry right there. So the leg that was created for us to come back down to close the order here is the leg you would use to sell high, and then you sell over here. If you have missed that, that is not a problem, because they will create another leg to close this liquidity, right? They will come and close this liquidity right here. You just do that for you. Your chart is clean. There is not a lot going on, not much going on. Liquidity. So when they close that liquidity based on that leg, they will do what? Right? Come down and close the liquidity. You're not selling. You're still in profit. Right? This. Right? Let me say that you entered there. If you're scared, that is, you can get out on the liquidity. If you want to hold for that liquidity, which is this one, you can do something like this. So they're going to come here, push back down, cancel this liquidity, come down. There is an orders, they left all these orders here, right? So right? When they left, okay, why did that happen now? So when they left that high. Then they did what? They want to come back up because the liquidity has been cancelled. So that means that they are done. So when they're going to come back up, that is a what now? A higher low, right? That's there. So there, because we are clear, they have to close liquidity again somewhere there, right there. So you're going to enter here on this arm. Okay, so our high, we're coming back out to cancel liquidity again. So you can enter liquidity. So again, you can enter here to cancel this low. And that's it. And then we can push to the downside all the way, canceling this liquidity and that liquidity. And it's simple as that. If you can look into a chart like this and draw a lot and not just wreck your head with studying a lot of things, just first, before you go to the candles, understand the structure. Even if you understand liquidity, even if you understand fair value gap, even if you understand imbalance, if you understand order block void, all those things. But if you can first understand the structure and why do we have all these terms, you will then find it easier to go through the candlesticks and understand what it means. But first understand this and you'll be good to go. Thank you so much for watching. Hope to see you again in the channel, and cheers.